All right, what's up, gang? Welcome to the Wallstreet Jackboyz Game Plan Sunday. Today is January 19, 2020, and we're kicking off our session. We're going to take a look at past week, what we noticed coming down the pipeline, take all that information and see if we can strategize and make some money from that. We'll take a little Q&A, take some stocks from you guys. Y'all know how we do. We're going to get to our money gang here. Last week, some significant things did occur in the markets as far as what the markets was anticipating. The major theme was the trade deal. Phase one of trade deal was signed and it's been into ink now. So that was pretty significant for the markets. The markets was anticipating that to go through, and we did get that phase one of the trade deal. So that was a positive note for the markets. The markets did tag new highs. As you guys see, we're printing at these all-time record highs. It's really, really, really crazy. At these levels that we are right now. So we're at really treacherous levels at these highs right now. But that was pretty much the main theme of last week was the trade deal situation with China. Did anybody get it? I doubt if you guys even had a chance to read through the trade deal itself. I haven't read through it myself. I'm actually going to take a look at it tomorrow, have some time off. But from what I've been seeing from the experts, that's, experts on the situation, the situation with the trade deal, again, this is just phase one of a four-part trade deal. I did see reports from Steve Mnuchin, the Secretary of Treasury, who was saying that, phase two of the trade deal, they may actually have to break that up in like four parts. I was like, what? They're talking about like a trade deal 2A, 2B, a 2C, and a 2D. This is crazy how they do this stuff, because at first it's supposed to just be a trade deal. Now it's supposed to be a four-part trade deal. To part two, we got phase one out the way. Now we're on phase two. Anyway, a lot of the stuff that they do is just word psychology, okay? You got to understand that the markets is all about psychology. It's not just money and numbers. It's really about psychology. Everything is to keep the confidence of the investors up, keep the confidence of the people up, keep the confidence up, right? Anything negative shakes the confidence and people start to sell off, and that's how you go into a recession. As long as the confidence is high, you avoid recession, basically. Okay, so anyhow, the phase one trade deal, what you got to know going into this week, basically, is that remember in December 15th, Trump's supposed to slap some extra tariffs on China. He did not do that. The markets was, unsure about that. That had this uncertainty risk factor that was in the markets, but that went away because he decided not to slap those tariffs on. That would have been really detrimental on the market, but he did not do that. The Feds also, they've been, providing liquidity in the markets, especially the repo markets. Repo markets is, in a mess right now. The Fed's been pumping up this whole market, to be honest with you guys. And as long as the Fed is there, the markets will continue to go higher. That's just what it is. A lot of the, fund managers, smart money, they're confused right now. You know what I'm saying? Like a lot of them are like stepping out, a lot of them even lost monies because this is not the way that things supposed to go, and so you can be right and not make money. This is the kind of game that we're in. And so we're all here to make money. Right. And so you can be right all day. You don't make no money. That's not what we came here for. We're here to trade, to try to make money. So we got to do what we have to do in the markets, but it's still good to understand what's going on overall. There is a lot of manipulation that's happening. And what we're seeing basically is we're seeing a lot of the shorts. Like we take a look at here at the S&P 500. What we're seeing is the confidence of the shorts, the confidence of the bears being broken, right? That's what has to start, right? So if you take a look at the S&P right here, let's go with, we'll go with yellow. All right. Yeah, this rally is out of this world, man. Like you get like these small little pullbacks like this, everybody starts to go short and then they get knocked out. And then the bulls take it from there. And then you get another little pullback, short started coming in and they crush the bears. Here we go again in another rally. These are the levels I got up above. Okay. You guys remember the markets like these whole numbers, right? 33.30, like that's the big thing. 33.50 is the next level. Smart money, knows that, these stocks are not worth these prices. Okay. But I was actually looking at some of the, I look at both sides, right? I'll take a look at the bears. We're talking experts here. Okay. And the funny thing is you guys got to remember, like I've studied data science, right? I have like certification in data science and all this other stuff. So I understand that there's different disciplines when it comes to data science. And so all data, as I told you guys in last game plan Sunday, all data is not linear. It's not just black and white. Data, a lot of the data that we're looking at is dimensional. It has all these different dimensions to it. But when you see the print, you just see the headlines of CNBC or what have you. That's just for Wall Street to rally. But when you dive into it, you see that it's more than just what they're telling you it is. But anyhow, looking at these fund managers, these institutional, buyers, these guys are picking and choosing the metrics that they're actually going to gauge whether the markets are overbought. OK, the markets are overbought according to the technicals, according to the earnings, according to everything else. But they have so many different metrics that they measure stuff in. So they picking and choosing like, OK, well, this one metric over here, they could be going higher because of this one metric. So we're going to focus on this one metric, but yet you ignore all the rest. All the rest of the metrics, the fundamentals and the technicals are clearly telling us that we're at a danger zone. This is way too high, way too high. Now, why is it this high? It's because the Feds are in the game. The Feds are supposed to be referees. They're not supposed to be in putting the jersey on, shooting baskets for the other team. They're supposed to just referee the free markets. But when they step in, the smart money knows, oh, we got the refs on our side. Let's kill it. And that's what happens. And we did an article on inequality and stuff like that from last year. And a lot of that was talking about, and the research that I did, the Feds had this FBR that they created, and they went to research this wealth inequality. You got guys like Ray Dalio and all this talking about the wealth gap is expanding. And so the Feds came to the conclusion that they actually create the wealth gap. And I try to tell people this all the time. The Feds create the wealth gap. They create the imbalances. But they say they can't stop it because they can't force people to learn about the markets, right? And they can't stop the people that know about the markets from taking advantage of them interfering in the system, right? So we're in a free enterprise capitalist society. And when people don't show up to learn this stuff, I mean, it's pretty much your fault at the end of the day. That's the way you see it. You know what I'm saying? And so that's another reason why I try to get everybody as much as I know. I don't know everything, but I do know a lot. And I try to give you guys what I learned, because if you don't learn this stuff, you're going to be a victim to it. You see what I'm saying? So, people go buy houses before the crisis in 2008. What happened? They lost they lost everything. You know what I mean? They had no idea about the economic cycles and how the stuff goes. And so we have all the experts, and they're telling you guys, we already know that we're in the bubble. We're at the end of this expansion. It's only a matter of time before this thing come crumbling down. Right now, they're doing everything in their power to keep the confidence up, right? You guys remember last year we had the yield curve inversion. And everybody was writing an article. We even wrote an article about the recession and all this other stuff. And that was when everybody was going short. All the bears is coming in. And they had to kill the confidence of that, okay? We got to shut all the talks about that up, right? We got to shut Ray Dalio, whoever's talking about it, we got to shut them up, okay? And it's funny because in his book, I don't even have it nearby, but if I show you guys in his debt crisis book, he gets like newspaper examples because he went back and studied all these cycles and traded during these cycles, and he learned from those things, and he put together this body of work called Debt Crisis. And so you guys can, buy his book. It's been very, very, very influential on me, and it's very informative. So, but he noticed that we go through these cycles over and over again before every, recession stuff. But some of the funny things that he also had his team to put the news prints, on the screen while he's trading these markets. So he see what's happening in the world in the news. So he has this virtual world where he's trading like real time, those events, and he's learning. And in those prints, he talk about how they have people that would go and inject money at the banks, right? Because the banks is messed up. They'll go in there and put, a couple of hundreds of millions of dollars. Back in those days, it was worth billions of dollars a day, a couple $100 million in the system. And then they'll pay New York Times to go print article that, oh, the Feds fixed it. Everything is good. The economy's great. And then people go back rallying back up until the next break. And then they go do the same thing over and over again. And it's funny because, when you read it and then you see where we are in real life today, we're seeing that happening in real time. So, the markets are going higher as the Feds continue to print money and participate. They're buying treasuries. The crazy thing is they're actually bailing out these banks before a recession. We're not even in a recession yet, as far as it hasn't been technically announced that we're in a recession, but they are moving like we're in a recession. Y'all don't find that to be strange, right? These banks are getting bailouts. They ran out of money. and the repo market is kind of like a pawn shop, right? You go pawn some goods so you can get some cash real quick, and you go back and get your good back. Where you pawning your ring or something, you go back, oh, hold it for me for a week, I'll get it back when I get paid. I just need some cash right now. Well, the repo market works the same way. There was an article that just came out also about how the feds are actually trying to get money straight to hedge fund managers through the repo markets now. This is a new thing. So again, this is the type of stuff we're talking about that you got to understand. At the top of the pyramid and at the bottom of the pyramid is regular people, regular retail traders. All of us, we're at the bottom. At the top, you have the feds. Okay, you got government, feds, hedge fund managers, corporations, all those people, and then it trickles down at the top. So one of the things when you learn about these cycles is that before we go into the next cycles is that before income is impacted, wealth has to be impacted first. So when you see wealth start to save money, that's when the beginning of the contraction starts to happen. So wealth starts to slow down on their spending, the wealthy at the top. That impacts the bottom. Then your income starts, people who are working 9 to 5s, your hours start to get cut and blah, 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 right? So always know what's happening at the top because it trickles down to the bottom. You're the last people to know, all right? So you got to watch what the top are doing. Last year, we talked about RVs, right? And some of my economic classes, we learned that RVs is like the #1 luxury items of the rich, right? And they got data on RV sales, right? And that's one of the first things that go. The wealthy stop buying RVs before there's a recession. This is something that you go back in history, you see over and over again. So you take a look at the RV sales, and if the wealthy are not buying RVs, that is another sign that a recession is to come, because now the wealthy are putting their money. They're not spending money. They may be investing in the markets or saving the money, but they're not spending, right? So when they stop spending, that's a heads up. We had the worst numbers in history from the RV markets last year. Even though people, the guys are selling the RVs saying they haven't seen it this terrible, right? So you have clues is there, right? And I advocate for you guys to check in real world, like in your real world, your daily life. I call them social indicators. You can see what's happening. For instance, case in point, then I'm gonna make my point. We're gonna move forward. But where I live here in Ballantyne area, we have these stores. We have like the Publix supermarket, Whole Foods, and then we have Harris Teeter. Now Harris Teeter is pretty close to me. It's a really good grocery store, right? You got wine, you got everything in there. It's crazy. They normally open 24 hours. Okay. When I first moved down here about 2 years ago, the Harris Teeter here, they opened 24 hours. And we had like 3 of them that was close by. They shut one down. We have 2 of them now. But they were 24 hours. And so I said, you guys know, after we finished, game plan Sunday, whatever, I head to the grocery late night and go do my grocery, right? Now we just order it. They just bring it to the house now. But they used to open 24 hours. And the one closer to me stopped that down. They close at midnight, right? So, in the middle of the night when the baby's sick and I need to go get some medicines or something, whatever I need to go get, I can't get it from there no more. So I gotta go to the one that's further down the road. And they used to be open 24 hours. But they're no longer open 24 hours anymore, right? I had to go way to the other side of town. This is like the past week, right? All the way to the other side of town to go get something after midnight because they're shutting down the hours, right? And I was at the grocery and I was trying to get some turkey from the deli. And the kid that was there, he was like, "Oh man, I'm closed. We close early. They cut our hours. I wish, I could serve you normally, but they cut our hours. And so we hoping to get this back. This was before Christmas, right? He was like, hoping we get our hours back, going into Christmas, but we don't know yet. So you see this type of stuff happen. Like, go look at your stores. Who's open late at night? You can just look at Google, do a Google search. Who's open late at night? Who's open 24 hours? You'll see the hours are cut. So you see like the job numbers that come out. They got these jobs that's being created, but they're not good paying jobs. A lot of part-time jobs is out there. And so you have people that work at, Harris Teeter or Publix. If these type of, people that's in the markets that's working and they get the hours cut and they're working part-time, what do they have to do to survive? They have to go get another part-time job. They have to go get multiple part-time jobs, right? So that one person now has 2 to 3 part-time jobs. That adds to the number of jobs that's created. So one person holds 2 to 3 jobs. Because they can't make it alone, can't survive off of, one job that's part-time to cutting the hours. Anyway, but you can see these things, you observe them in real life. You don't need a degree in economics to understand that. Now, some things are not apparent to you. You don't really understand unless I tell you, but take a look at things that you normally would buy. I was taking a look at like bags of chips, right? Bags of chips, the price itself is what you would normally see. But if you take a look at the quantity, the ounces, You see how they cut the ounces of the bag is still like the same size, but you're getting less chips in there. That's also, depreciating your money. All right. That's another form of inflation. You see it. So you got to be a student of the game. Always be learning. Everything isn't just about trading stocks. A lot of stuff has lasting impacts on everybody. So I do want to cover some of that stuff for you guys and see what's happening. But what's happening is that the feds are interfering in the markets, and there are people that's taking advantage of it. That's at the top, the people at the bottom. You guys are watching football. You're watching every football game. You're watching what's going on Power. You're distracted with all these things while money is being made around the clock. I can't force people to come to show up to Game Plan Sunday. We do this free every week. I can't force you to come and show up, right? But the people that do show up are going to get a lot of value, and hopefully you refer somebody to come over so they can get this value too. But we can't force people, that's what it is. The Feds is like the same way. The Feds said we can't force people to learn the markets. When we come in, that's people that know we stepping in the game, and they come in and they rally up. And so that's how you get the wealth gap that expands. So the Feds have been interfering in the market since September, and also cutting interest rates at the same time. It's a double stimulus. And we're not even in a recession. That's worrisome, right? Because the Feds only got 1.5% interest in the tank, 1.5. So they normally need 5%, remember, to save the economy. They don't have that in the tank. So what they did is they stopped cutting the interest rates in December. And they said, well, we're not going to cut no more. We've given the markets what we're going to give the markets. We're going to wait and see right now. And they're saying that inflation is not even apparent. Inflation is dead. They had this goal of 2%. They cut the rates to get people spending money until inflation hit this 2% target. Right now, we're at like 1.83% on the inflation, right? And they're trying to get it to 2%. Inflation has been dead since whenever, because they're not measuring it properly. The two things that you need to survive is energy and food, and they do not include energy and food in the CPI numbers, as they call them, CPI numbers. Some people call them CPI numbers. They don't include food and energy because it says too volatile for them to calculate that. So the things that you need to survive, they don't even include that. And so they're trying to get to that 1.83%, not even including that, right? And we're already beyond 2%, all right? All the money that they're juicing up in the markets is ridiculous. But the Feds are playing a dangerous game because they're going to cook the market, and we're going to have hyperinflation. By the time it registers, you got to understand some of these things are lagging impacts. That's right, Dustin, they're using all the resources. So some things have lagging effects. So by the time they see it, it may be too late, right? Your cost of living is going away. We just saw we got the wages and numbers. Wages are stagnant. They're not even going anywhere, right? Your wages ain't going nowhere, but your cost of living, cost of everything in life is shooting up. So that means, your currency itself is depreciating. You don't have the same purchasing power that you used to have. So monetary policy, that's what's held by the Feds. Fed says that they've done everything they can give to the markets. We're not even in a recession technically, right? But we have clues, but they haven't announced it, right? But why is the Feds interfering in the game when we're not in a recession? They interfered when Obama took the recession, right? And they pumped in all the money and had to get the spending back. They had to get people back spending to get the confidence in. And we're supposed to be in the greatest economy, right? According to Trump, we're in the greatest economy. Why is the Feds in the system? Why are they buying up treasuries? Okay. These are things that you guys got to understand. The Feds are also talking about trying to get out of the system. But you see, Wall Street knows that they're in the system, so they're racking up, and it's feeding the beast. And when the last time that they tried to raise the interest rates, if you guys are in the markets, 2018, let me go back here. All right. Last time that they tried to do that, we got that major sell-off. All right. This is on the weekly chart. Bingo. That's what happened when they try to raise the interest rates. Okay. So when they raised the interest rates, Wall Street wasn't happening. So then they said, okay, we're not going to do anything. And then we're not going to do anything. And the market started drifting here. Then they started cutting rates. Bingo. Now that's where we are now. So we're like these parabolic highs right now. It's crazy because the Feds not only did that, but they also started juicing up the repo markets. And that was around this area, right? Repo market had, its little imbalance where the banks ran out of money. The Feds had to come in and juice up the system, put money in the system. That money is circulating in the system, but it's not going into the people. So you're not getting real economic growth. GDP is still slow. It's in the financial markets, right? So these guys are getting all this money, right? These banks, these financial companies, and what are they doing with it? They're buying back stocks. So people that own stocks, their wealth is going up. I actually just pulled a report. I don't even have it up here. I got it on my phone. That was just showing how all the wealth is concentrated at from the top, percent of people. And just understand, when I was looking at was that 3% of all Americans, only 3% are millionaires. Okay. 3% millionaires, right? That's a really small number, right? People, if you look at, Instagram and Facebook, you think everybody ain't mama millionaires, but really only 3% of people are millionaires, which I find that crazy, right? Because you don't, you think that everybody's just a millionaire, but no, that's not true. Only 3% of people are the millionaires. And they said that the holdings of these, the ultra rich, the rich and the ultra rich is in stocks, not real estate, but stocks. And that's interesting because that's how they get their wealth built up. That's why you guys see like Jeff Bezos, and they talk about his net worth. Oh, he's a billionaire, he's ultra billionaire. Or, Elon Musk just lost billionaire status, or blah, blah, blah. Now he's back billionaire status. And they're looking at their stocks, right? When stocks go up and stocks go down, right? That's part of their assets. So anyway, that's another important reason for people to be involved in the stock market. But I can't make you do it. You see what I'm saying? You disqualify yourself. You don't think you're smart enough? That's only you. I'm telling you that you're smart enough and anybody can do it. But you do have to learn. You do have to be a student of the game. And that's why we're here. So anyhow, with that being said, that's just the environment that we are in right now. OK, we do have, again, PMI numbers and recession levels. We got some housing data that's coming out this week. It's really not going to move the markets that much, unless it's really bad. That doesn't really move the markets. But Trump actually did get the trade deal for phase 1 completed. So that's a victory that he can brag about for the election. You got to remember this in the election year, 2020, November, people are going to be going to the polls. So the confidence, Wall Street backs Trump presidency 2020. Understand that they need for him to win because he's helping corporations out with those tax cuts. That has been very beneficial for, U.S. corporations to be able to generate all these highs. That's a cut in expenses, a great cut in expenses. So that's been good. The phase phase 1 of trade deal has been another good thing. And then I think it was a Thursday we had the USMCA deal. United States, Mexico, Canada. I say UMC deal, trade deal that was signed, sealed, and delivered. So that was another victory on Trump's behalf as far as trade goes. These are all positive things for the markets. And so, those are good things. What's next, right? So what's next is, again, we got phase 2 that's on the table right now. We got to see how that's going to go through. They're talking about breaking it up in 4 parts, but they're trying to get this done before, the election, right? They're not going to get the whole trade deal done before the election. But it's interesting to me that, China will go into a trade deal with Trump knowing that he could possibly lose the election when they can get a better negotiation with a Democrat versus Republican. So for me, it says to them that they don't even have confidence that a Democrat will win because they already started in a phase 1. Now, another thing is that what is that trade deal? So the trade deal itself is really just stimulus for the farmers, right? The farmers are negatively impacted. The Chinese have agreed to buy all this agriculture from the U.S., but they got to uphold their end of the deal, okay? Now, that's the mystery. You got to know they're going to uphold the deal. And there's a lot of experts that don't believe that they can even uphold that kind of deal. I think it's $200 billion they agreed to buy in agriculture. They already got buyers, right? And so if they had to agree to up, their supply from U.S. versus the people they're already dealing with, then that means somebody's going to have to get cut. So the other foreign people that they're dealing with, doing trade with, they're going to have to get cut in order for them to take on this deal with U.S. But I did see that there are a lot of experts that don't even believe that the numbers that the Chinese have agreed to in this trade deal are even realistically obtainable. Again, that's more headwinds, that's more risk ahead of the game, and they feel like this whole thing could fall apart if that doesn't come through. It's still risk, right? But for Wall Street's sake, everything is good. Everything is good and kosher. Markets is, great, beautiful, right? But I just want to give you guys 2 perspectives to understand what's happening with that. Okay. So coming up this week, we have the market. Again, you guys understand that, Martin Luther King Day is tomorrow. Hopefully you guys celebrate it. I'm over here teaching my baby about it. Very historic time in history, especially for African Americans in this country. And this country as a whole, to move, with equality and civil rights. So the markets are going to be closed in observance of Dr. Martin Luther King Jr. Day tomorrow. So the markets will be closed. Futures are open right now, but the markets are going to be closed. So the markets will resume on Tuesday. What's happening on Tuesday? We got the day in Davos, the World Economic Forum. They have this every year where all the, the richest people, the top dogs are going to be there. Trump is going to be there. These are the guys that run the world, okay? And they're going to be having their meetings in Switzerland. They do this every year. of what they're going to be doing, right? So that's going to be happening on Tuesday. If you guys can catch it, cool. If not, then we'll cover it next Game Plan Sunday. We do have earnings. Remember, we're in earnings season right now. So we're actually anticipating, these companies' earnings. The financials were pretty, chop and screwy. I think JP Morgan did really good last week. But the financials, they pretty much delivered, last week, and it was all right performance. Tuesday, we have Netflix. I'm definitely going to be watching Netflix. I still got some bullish exposure in Netflix. We got Capital One that's going to be reporting. On Wednesday, we got Johnson & Johnson. We got Texas Instruments. Who else we have? We have, those are pretty much the main highlights on that one. I think we have Thursday, American Airlines, Comcast, Procter & Gamble, and then we got Southwest Airlines. So it's going to be interesting to see how Procter & Gamble does, and American Airlines. And then Friday, American Express is pretty much the big name that we have on Friday. So I think Friday is going to be pretty light. We got some housing data that's coming out on Wednesday. On Tuesday, we got the Bank of Japan that's announcing their interest rate decision, and they're at negative interest rates. You got to remember, U.S. is the only country with positive yields right now. And so that's another reason why the markets are going higher, because investors can't get yield in the bond markets. So risk is on, right? You might as well get some equities to, take on that risk to get that, because yields are negative around the world, except for the U.S., right? I mean, you factor in inflation is really a wash. So risk, smart money is putting their money into stocks, Unfortunately, it's like, hey, they'll take the risk, because yields, bonds ain't giving you nothing right now. So it's negative in Japan. Consensus is that they're going to actually, maintain without any cuts or anything. They're just going to keep it at negative, I think, negative 0.1%. And then we have Europe, who's doing theirs, I believe, on Thursday. We have Christine Lagarde. She's the head of the ECB now. Mario Draghi's out. We have Christine Lagarde. She's the head now. She was the head of IMF. She switched over. She's running, Europe right now, basically, the Bank of Europe. And so they have negative 0.5% in Europe, and expectations, consensus is that they're going to keep interest rates, the same. So those things could have impacts in the markets depending on what their feds are going to be doing. But that's pretty much it as far as what I see here on the table. Not much of anything else. So with that being said, let's just take a look at the markets, see if we can find some plays. I'll take some from you guys. I haven't really been able to find anything over here yet because I've just jumped on, but I'll take some questions from you guys. And we'll take a look at some of these things here. Now, last week, utilities had a squeeze pop. Okay, so last week we had utilities that had this nice squeeze pop. As you guys can see, the weekly setup on utilities is still on. Okay, it has burst through the first extension, but as you guys can see here, the squeeze on the weekly is still on. The trend is moving upwards. All right, the stochastics and everything is moving upwards. We went from this high to this swing low and up to this extension is where we're targeting, but we've already cleared pretty much this first extension at the 127.2 extension. Then we got this next one coming up. But that's utilities in that squeeze. And that's interesting because normally, as you see in the past, when we have a weekly squeeze, the markets drift up, pop up again. You have this other one. This actually went up a little bit more. And then now we're back in that zone. And so we're expecting that to continue to go. Now, the daily squeeze on utilities did fire long. Okay. And so this is a really good move here. It was a short squeeze because it was only, it was a short duration squeeze. It was only 3 dots. And then it went ahead and fired long. Now, it's crazy because the markets hit new highs. Meanwhile, utilities went high. Now, utilities is a proxy for bonds. This is a safety net, right? Smart money, put money into utilities when there's, danger or risk. So it's either gold, right? You have commodities, you have bonds, and you have utilities, right? And utilities is just a better play than like bonds right now, right? Bonds is still in a really interesting situation. So let me just take a look at that one real quick. Bonds is in an interesting situation because bonds in a really interesting situation because we had a fake out squeeze, right? We had a fake out squeeze. Everybody was gearing up to go long here. And then it did this little pop and then it just came down. So the squeeze didn't materialize. This is the shakeout the bears, which, if you're long on, bonds, then you're bearish equities, right? And so that's to shake up the confidence. And then those shorts, those guys who's bullish here, they're actually bears in the markets. So they shake them out and they start to sell off. And so we're going to see the price action here. The way that it's looking, it looks like pricing is going to come down to the 100 right here, this gold line. And so I kind of expect for it to come here anywhere. If the bonds hit this zone here, that's going to be a buy level for me. All right. So that's the bond market. Let's take a look at gold as well. I want to show you these themes here and I do have some exposure in gold, just due to the markets in this melt up right now. All it takes is one little mishap for the markets to come plummeting down. All it takes is for Iran to retaliate or North Korea to get out of line or what have you, and the markets is going to puke. It just takes just a little bit right now for that. And so gold is still on play. You guys can see what we got here in gold, from that play down, pop up here to that high, and it's down here consolidating on the non-moving average, still bullish, right? This could come down some more, but I'm expecting for it to go, a little more sideways and maybe drift back up, depending on if risk comes back in. So the reason why I did want to get some exposure in gold also is I'm showing you guys the VIX, which is the fear indicator. All right. So the fear indicator right here. This is, complacency in the markets when, people get greedy or when people get fearful. That's important to understand where we are. That red line is significant. We've been holding this line for a very long time. As you guys see, this here, only time it breached was this one time it breached. Everything else was pretty much held, and it snapped right back after it did that breach. So this is where we are again right now. And what this is basically telling us is that the markets are over greedy. Okay. So they're overly greedy. They're greedy. We just saw the markets hit all these crazy record highs, and they are extremely greedy. Now, the VIX indicator is not the law, right? But as you guys can see, every time in the past, when it hit these lows, it bounced up, and it bounced up with a strong move. Every time it does that, it pretty much had these strong, violent moves here. And so to prepare for that kind of risk, I did want to get some exposure on. So, some hedges that's in the game right now. So you want to get some hedges right now. Doesn't mean we can't go lower, but the probabilities of that, doesn't mean that this can't go lower. It's just the probabilities of it is highly improbable. It can still happen, but it's more of a probability that we get this reversion to come back up. Okay. So that's why I'm like, okay, we're in a treacherous zone right now, because the VIX tells you that the markets are too confident. When they get too confident, they start buying crazy extreme highs, then we get that rip up. You see what I'm saying? You get those rip ups, right? And so we're due for another one. That's basically what I want to get to, is that we're due for another one. So that's what I'm expecting in the VIX, is to rise up in the VIX here. And I think that's pretty much it overall. Things that you guys need to know going into what we have right now. Dustin, got nothing, started new. Okay, so you've been swamped. The cannabis plays went off. Yeah, I was like, I told you those cannabis plays, they were at lows. I mean, those at very attractive prices. Ron had a nice attractive play in Junia also. I don't know if you guys saw that. This is a stock that you could have bought. We covered this a while back. This is supposed to be like the Amazon of Africa, basically. Okay, they do like the same thing that Amazon does, but they're covering the African market, so they're new in that space. And Africa got a lot of money that's in that place. Africans been using smartphones for the longest, kind of like China, right? And so people think that they're so primitive, but actually they're not primitive. They may be poor, but they got a lot of technology. So Junia is a German company that's invested in this space, and you guys know Germans, they're really good. So anyhow, this floor was really good. We caught this a while back. Ron brought it back to my attention. He's been, hawking me about it. And so I'm like, yeah, this is a good buy point. When you take a look at this thing, I mean, you're looking at a company that was trading at, again, this is stocks, $49, right? It started its IPO here about what, $15 or so, and then it jumped all the way to $50. So we already know, they're ready. We got buyers in there that's ready to buy this thing at $50, right? So if you could buy this thing at $4 or $5 or $7 a share, why not, right? Because it's pretty much at its lowest. It's getting ready to pop up here even more. So this is a good entry point on this. So y'all credit Ron for that. I know I covered it also, but definitely this is good. So shout out to Ron for that. What else we got, you guys? Yum. Okay. Yum Brands. Let's see. It's right here on the chart in front of me. Yeah. Okay. So Yum has this gap that it needs to cover. It's been a while since I covered it. Let's see. All right. Let's see here. Yeah. Can't get no levels on that. But what we can do is I could take from this swing high to this swing low, somewhere right up here. So in this particular chart, what you can see here is that the 100 moving average above is where it's migrating to. Okay, this was the floor. You can just look at this and see it gap down, chop sideways. This is a good entry point that we got here. It's been trading right at the mean, and it's been drifting, and now it's popping. All right, it's popped above. It's coming across the 100. I said this is the 100. This is the 200 moving average, the yellow line. The 100 is my blue line. So it's coming above the 100. The 200 is a key level of resistance. So, you can see this drift up into that. It does have a gap that it wants to fill. So the 618 retracement is here on the bottom. But yeah, somewhere around this level is on Yum. ED, this is, let's see. All right, so we got a double bottom play here. I got some old zones in here. Let me get those out. All right, so let's take this high to this low to get some levels here. Let's take this high to the same low on the Fibonacci, and there you go. So there are your levels there. I imagine that you're trading this bullish, Ron. Hope that's what it looks. So you get that double bottom kind of set up there. Trend is up, momentum shifting up, everything is shifting up. You do have to keep in mind you got that resistance level up ahead. So just track that. But again, that's still another bullish stock there. Amazon. Let's see what we have on Amazon. Amazon is in an interesting situation. It is starting to form maybe a bull flag that it's trying to form here. Do have earnings coming up on the 30th. So the end of the month, their earnings are going to be in play. Now, I'm pretty bullish on Amazon for earnings, though. Amazon, they normally do pretty well. The retail sector itself is in a squeeze, but we could take a look at that as well, which is interesting. And it can go either way. If Amazon pops off, then that would definitely be interesting. But Amazon is, let me see. You can see Amazon is trading sideways, kind of like this. This could be a bull flag that it's doing. What I would like to see this thing to do is see if it holds here and then see if it makes a rally back up. And it may be a play into earnings on Amazon. It's kind of exhausted, but I think that earnings investors may be looking to get back into it around that time. But right now, I don't have any setups clear on Amazon. What else? Apple, same thing on Apple, I believe. Apple is out of here. You guys know I don't like buying extensions, and I don't have any levels anywhere higher. I don't even think we have anything on the voodoo lines that's been even updated. But these highs are just over. This is too high for me. I don't have any levels, so I can't make an intelligent trade on Apple right now. I do see volatility is really high on here. So if anything you want to sell, that volatility is high on Apple. AEP, let's take a look at AEP. Okay, Terrence, better late than never. Glad to have you, man. All right. AEP, this is another move here that's already taken off. What was that? That's that Kareem. You wanted to be in this play before it took off. You wanted to be in this play when it took off. So when it was trading right down here, this 618, and it started to reverse and it crossed over, you wanted to get in at around this time. We had a little short squeeze. It was only a 2-day squeeze. And we had a buy trigger here. That would have been the move you get in before the takeoff. It hit this first target, and I can make it to the next target up above. But just as a rule of thumb, you don't want to enter in at the extension targets. This is where they feed the ducks off to the rookie traders. All right, because you see the move, you say, "Oh, let me get in there. That thing is popping off." I noticed that you also called out Visa, and that's another situation. Like Visa popped off in the same manner, and it's kind of like, well, we're too late to the party on that one. But definitely was a good move. If you could have saw it ahead of time, then yeah. This is the one that I believe you called us one out in the group on Visa. Again, this is another one that's overextended, hit those new highs, breached all the levels. I don't have any intelligent levels to even make a trade on this one to the north side. It has cleared all our levels. So, and it's extended, it's overbought. So you don't want to get in at the overbought territory. What else we got? Okay, GM, looking at 38 on GM, 34. Okay, so you want to trade GM. All right. GM is an interesting situation. General Motors. This thing has just been trading, sideways. You guys can see clearly in this zone here, right? So this stock stays in this zone. That's what we're seeing here. So you can pretty much kind of calculate this at this zone. You already have your floor here in the nearest term. So from this high to that low, and it's making this march north, slowly here. Just keep in mind, you got this 100 moving average and this 200 moving average. It's going to be key levels of resistance. So yeah, it can go up. I'm not too sure the liquidity on GM, but it's not a name that I typically would trade. Let's see here. 9 million in volume. It's got two points of movement in it, 2.5% of movement there. So you can just add that, say $3, so about $38 to the north side, about $32 to the south side. That's the expected range within 33 days on this thing here. So, that's your range that you're looking at. We just talked about 33, somewhere around 33 to 38, right? So that's where it's giving us the expected move, somewhere around here. Yeah, so at least you got some range there so you can make a decision. But it's nothing that I really care to play. But you can. But I just want to give you a little perspective on the range there. Been a hard time clearing those moving averages. Yeah, it does. As Dustin pointed out, as you see, if I can let me remove that so you can see those moving averages. This is my favorite indicator, man. Again, you don't need a lot of tools. If I had one indicator, in fact, let me ask you guys, if you had one indicator to trade, okay, what would be that indicator? For me, it would be my moving averages. I don't have to have anything else, but if you give me the moving averages, I can make some money, okay? So you want to see those moving averages. It definitely has a hard time clearing those every time. So boom, boom, boom. Moving averages is where it's at. So what else we got? All right. Okay, yeah, moving averages. Yeah, but again, it has to attract to those lines. So I was bullish. Yeah, same thing. All right, so we got a few more I can take from you guys. We got Google, ATVI looking very bullish. Dustin, okay. Let's take a look at Google real quick. All right, same thing here. Again, Google is the same thing. We're overbought, fear of missing out. This thing is, it's way overbought. And so for that reason, I don't like Google. Yeah, this is not a place that I would enter in. They do have earnings coming up, and that can go either way, depending on their advertisement dollars that they were able to make, if they were able to make any. I think Facebook is going to do really good this year, but I don't know about the rest. Let's see. ATVI, Activision. All right, so Activision, this one actually looks pretty good. For those that don't know Activision makes video games. They actually make Call of Duty. So if you have kids and they play Call of Duty, You could buy your kid stocks in this company, ATVI, or have your kid to buy the stock. Say, hey, you want to play video games? You need to be invested, right? So ATVI, that's just the company that makes that. And their game is, you know, Call of Duty is always like #1 seller. They always normally do pretty good. And so this thing has been going north. It's in a squeeze, a bullish squeeze at that. Trend is moving up. Everything is looking positive for this one here. We are at an extension level. So that's going to be interesting. But let me take a step back because sometimes I got to get a bigger perspective on this thing. Okay. All right. So I cleared that level. And if you can just take a look on the weekly, that's like a big gap down. It wants to come back up to chase those new highs. It is far away from that. I don't know if we're close to that. But around a $70 target, if you can see from this peak here in this range, I think that may be if this thing pops, to the north side, this would be a good target. So again, my Fibonacci is limited at this 62 level, but if this thing really pops off, I got 70 at the tops on that. Yeah. You like ATVI? Yeah. So I do like ATVI. I think that's good. Again, it's a nice one. I don't really have any upside targets here, but on something like this, the way that I would normally trade it is that I would trade my percentage targets. I would do a percentage target on this, which again, I'm trying to take 50%. So if I get into a trade like this, I'm gonna go ahead and put my closing order in at whatever the price is going to give me that 50% target, and I just let it ride, right? And then and let it get filled. So it doesn't matter if it blows beyond these levels. I get filled at that target, I'm out. Okay, so that's the way I look at that. Hit trillion, yeah. Google hit trillion, yeah. Hit the trillion market cap. Might be a little sell sign mentally, yeah. Like it's a psychological level for Google to hit that. But they're extended. When do you start shorting? You start shorting when you get stocks that are, they're in this overbought territory. So if you have an RSI, which I could pull it up, but I just pull up my Ready Aim Fire tool here, which is pretty much the same thing. So basically what you want to do is find stocks, like just imagine this is like a basketball court, right? Or a football field, right? And you got your bounds. So this is out of bounds here. And this is out of bounds here, okay? Stocks should normally trade within this range. Anytime they go under, which is here, this is oversold territory. So this is where investors like to buy when they see these things go down here. Now, when investors see it goes way out here, out of bounds, they say, oh, no, that's too expensive. Your price is way too high. You need to cut it. Okay, you know the song, right? Your price is way too high. You need to cut it. Okay, just think about how, in the dope game, like, okay, you got to tell the Connect, your price is too high. Well, it's the same thing in the stock market world, right? You want to be buying in these areas. So when you get out of bounds, you got to tread softly. So it's kind of like what we see here. When it's out of bounds, you need to be cautious up here and people start to short. It doesn't work every time, as you guys can clearly see. It just never really did anything. It just went sideways and then it popped up. So it cleared the shorts out. I mean, it broke the confidence of the shorts and they got to cover and they make that thing pop up. So it can still go either way. Again, there's no trading can be a little abstract at times. We have basis of ground rules, but it doesn't work that way every single time. So don't be rigid in your mindset, but just understand what you're seeing and just have that to help you to guide your judgment. If you just see back here, it did work, right? It was overbought in this territory, and the way that it normally works, it will sell off. And so we did get that move here and sold off. And then you did get here, it hit that oversold territory. It means, too many people sold, right? And that was an earnings split. And so investors said, this is an attractive price. Let me get in right here. Boom. And so now it's been drifting up higher. And so the buyers that's in here, they already made their money, right? And they hit this new high. So they hit these next extensions coming up. You're going to probably get some selling. So again, this is one of those situations where it could go either way because it's in a nice bull squeeze and it can go all the way through. But I would still, be cautious on that. Because they hit this level, this could be a level for them to sell off and it may reverse. But right now, it does look bullish. Okay. Yeah, Apple, Google, Visa, those stocks are really, really overbought. And so doesn't mean they don't mean you need to short them. But You can also stay away from them also. Like, because again, do you really want to short a stock like Apple, who's driving the markets? You know, Apple is like the heaviest weighted stock in these indexes. You know what I'm saying? Like, so when Apple moves up, stocks moving up too, right? You see Apple fall, then you know you can pay attention to the bigger indexes. They start to fall also because they're weighted. So you got Google, Apple, and all those other ones. So anyhow, that's that for that. Anybody got anything else that you want to take a look at before we bring it to a close? So watching Trump is on reason for it, not according to, okay, Arlington's being a distractor. I see. What's good, Arlington? We give you a shout out. I know you want some attention there, my man. SLV, so you want some silver. Yeah, so silver. I believe there was somebody that was in the group that did bring this out, but this is the ETF for silver. As you guys know, silver tracks gold. If you want to buy gold, gold is really expensive, but silver is not. Silver is going for about $17. Let me see, $18 actually right now. If you look over here, you can see silver's spot price $18. So if you want to get some exposure in gold, can't afford it, you can always buy silver. Silver's really cheap, $18. Probably get it for around $20 in the market, but that's better than buying gold at gold is at $15.50. I want to say 15 something. Where is it at? Gold is $15.57. It's really expensive. So, but they move lockstep basically. Silver would make pretty much the same move normally. So, yeah, I can see silver being a move here. It did bounce off this moving average here, and it's sitting on top of the 9. It could go either way, but it's in the zone where we're seeing, if risk pops in, then investors are going to be buying silver to the north side. So yeah, I do like that to the north side. We stock CGC. Let me see. Okay, so we're right here at time. We'll make this the last one. So the CGC, yeah, again, this is the last levels that we did on it. Up until that 200 moving average selling. On the daily, no squeeze setup, but I feel like that's set to getting some momentum back. Yeah, there's something happening with the weed stocks. Actually, I don't know if it's this week, but this legislation, some kind of legislation for I guess CBD or what have you, which is supposed to be positive in the sector, supposed to be happening. If you guys find out, let me know. But something's supposed to be happening. So you may have speculators that's getting into the zone right now if they're feeling like anything positive is going to happen. It is a bullish stock. It is getting into these overbought territories. So I don't really know what to expect out of it. The squeeze did fire off. So that kind of move is still in play, but it's kind of not really popping. Normally we get that squeeze fire. It really fires long, quick. It could go either way though. But definitely you want to be out at the $30 target. Okay. If this thing continues to move north, that moving average, okay, that's golden. So if it moves up, right, then you want to be taken out at that moment there. So, but again, tread softly because you're at this overbought territory. But these days the markets don't really give it, a D about that, right? They're like, the Feds is in here, man. The Feds is participating. We're gonna buy whatever we want to buy, even if it's expensive, right? And that stuff don't make sense, but that's what's happening. We got gold play. Ron called out. Okay, cheap gold play. Yeah. Okay. This is another one. They have a 2-day little squeeze to firing along. I don't have any extension levels to the top, of course, of the Fibonacci, but the chart itself overall is bullish. You may just want to buy this one here since it's so cheap. It's only $11, but yeah, if gold is moving north, then this is more than likely going to move north with it. Okay.
All right, gang, that's it for Game Plan Sundays. But going into this week, remember, Monday the markets will be closed due to the observance of Dr. Martin Luther King Jr. Day, so spend time with your family and chill. Just relax, okay? Tuesday, we'll get back into the markets. We got earnings kicking off with Netflix, so that's going to be major holding on to the markets. If Netflix mess up, then we don't expect good news from the market. So just keep that in mind. Netflix is in focus. Also, Capital One represent for the financial stocks. On Wednesday, then you'll have Johnson & Johnson, and then you have Texas Instruments. And then on Thursday, you have the airline companies. You got American Airlines, you got Southwest Airlines, and then you'll also have Procter & Gamble, so keep those in mind. Friday is going to be pretty light. You have American Express, which is one of the big names we'll be paying attention to, represent for the financial sector as well. Other key things to remember is that the Bank of Japan is going to be talking about their interest rates decisions on Tuesday. And then on Thursday, you have Christine Lagarde leading the European Central Bank. She used to be the head of IMF, but she's actually going to be discussing the interest rate decision from the European Central Bank. So these things may have impacts on the markets. Also, remember that Friday is the Chinese markets will be closed because of the Chinese Lunar New Year. It's going to be on Saturday, and investors are expecting a lot of money to be spent because they kind of designed this holiday for the people to spend money through digital purchases, through Alipay and stuff like that. So anyway, keep your focus on the Chinese stocks for that. And then Tuesday, kicking off the week also with in Davos in Switzerland is the World Economic Forum. So I'll keep you guys posted on that. But those are the key things going into this week to keep in mind. Anyhow, if you like this video, make sure you guys hit that like button and subscribe. And to watch more from Wall Street Jackboyz, just check out these videos next. Peace.